Hey everyone, let's go over Super Micro Computer. We got a double in the common stock, not the options, in a couple weeks or so. So let's find why and let's go over the chart, shall we? So let's dive into it. Very happy with today. They had some news that they are replacing their CEO or CFO, pardon me. And actually, if you have the option scanner, which may be available, check the link in the description if you want it. If you don't, feel free to join the free Telegram. It's completely free, so why not? But we saw literally with 1 minute left on Friday's session. Remember, markets closed at 1 p.m. on Friday with the day after Thanksgiving. We saw about 175K of the weekly 35 calls. And well, today those weekly 35 calls are up 325%. So let's go into the chart of the why. Why do we have the move? Why do the bears, and there was a lot of them who were shorted, why do they get their booty squeezed out? So our first look at Supermicro, we had the gap down when they had their accounting firm leave. Then we had, again, that second day of dip buyers. If you want, scroll back on the video. We went over this already a couple weeks back of the why. So you had the first buyers get burned. Second buyers, they cried. And the dip buyers here who thought they were, yeah, you're right, well, they got burned again. So basically, we had our last flush over the previous low, which was here. And that's when we started seeing deep in the money call buying on the option scanner. And you see volume picked up. Not only did we have a follow through, we had our gap in volume has basically been picking up ever since. So why? Well, shorts got squeezed, quite frankly. I mean, yeah, you're going to have news, and they had news, right? But shorts piled up thinking the stock would get delisted. So that's why you had such an aggressive move to the upside. And now we had the last shakeout right here. So people are going to buy over a previous high because they thought, oh my God, we have our gap fill. Remember, trading's not that easy. So what happened? We went down, actually took out stops all here as the stops sold and puked out their gains down in here because of the shakeout. Just so happens you get the squeeze today. And we have about a 30% rally in the stock. It was up to 44 earlier. So now basically, is the trade over? Just about. I mean, you got to about 46, 47 to 50. That will fill the gap. What you can do if you want, and again, if you want official trades, sign up, get the Telegram, get a program, get the scanner. Make it easy, right? Stop guessing. If you want to do an official trade on it, or to do a trade, I should say. Official trade, you got to pay to play. Hey, I'm an expensive, well, anywho, we'll be kind here. But you see volatility is starting to creep lower, right? And what's going to happen as the stock goes up now that there's all the uncertainty is gone, volatility is going to continue to move lower. So to play that implied vol crush, you don't want to buy calls because the price of the calls, even if the stock goes up a little bit, could go down because of implied volatility. But what you can do as a trader, and something I'm looking to do, is go ahead and sell some darn premium. And I know it's not sexy or anything, but when you sell premium, you want high implied volatility and want implied volatility to go down. That's what I'm looking to do. So let's say I go give myself a cushion. Let's just price these out for shoots and giggles. I can sell 35 puts for about $1.80, buy the 34 puts, and I could get somewhere around, let's just say 28 cents, right? Maybe if we get a little quick drawdown, maybe I could get 30 cents, right? Maybe the stock sells off $1 or $2, maybe $1. Don't need too much. Therefore, if I want to do a trade like this, what I can do is do a bull put credit spread. Sell 35 puts, buy the 34 puts, and I'm risking about $70 a contract per one lot. I do 10, risk $700. Do 100, risk $7,000 to potentially make $30. So if I do one contract, I'm risking 70 to make 30. Do 10 contracts, I'm risking 700 to make $300. Not a bad risk versus reward. And I say that, why? Well, do I think Super Micro Computer is going to go down about $2? Probably not. Or $7? Probably not. If I analyze the trade to see what it looks like, because you always want to see what is my max loss, not what is my max gain, right? Little tip there for the beginners who might not be thinking that way. What you can do is see the risk versus reward on a graph to look at the probability. So if I want to do a probability trade, I could go and I can actually see my loss if shares are below 34 on December 20th expiration. I lose my full $700 or $70. We'll do one contract for shoots and giggles. If shares are above $35, I make $30. But what is my probability of that? About 60, can't look at that here, about 68%, about 32% that my trade will be a loser. So decent risk versus reward. Usually you're going to have 70%, obviously, 70% trade favorite to make 30%, get it? So it makes perfectly good sense for a trader to do something like this to capture the earnings event, and also to, or not the earnings event, just to capture implied volatility decreasing, make sure shares stay above $35 a share. Also too, what is Super Micro doing to NVIDIA? Starting to eat a little bit of its lunch. Ooh, sounds bad, doesn't it? Because you see NVIDIA here still stuck. We had a dead cat bounce Friday on no volume. Today, no volume. Shares basically hunched out there, but you're starting to see some rotation out of good old NVIDIA into Super Micro Computer. Let me know what stock you want to look at next. Leave a like, leave a reply, all that good stuff, and leave a comment. Subscribe to the channel. I usually respond to comments, so get there soon. Recovering from a cold, so I'll be back to normal hopefully in a day or two.